de-escalation of the trade war is holding the key to the whole market. We've been in a two-tiered market all year, where companies levered to the U.S. consumer are doing well, but companies levered to the manufacturing economy are having a very difficult time. And for the pressure cooker to come off those companies, you really need a de-escalation of the trade war. So the market's right to react this way, and a soothing of the tension there would be very positive to reaccelerate the earnings and the opportunities for the companies in the back end of the economy.
Mixed signals on the economy today, Barry. So we did get that second look at second quarter GDP, which was quite good. In fact, the consumer spending component up to 4.7 was a lot better than what was originally reported. But then we got a drop in pending home sales, something that we haven't seen, a level we haven't seen really in months. And jobless claims, mini tick up, still at low levels. What do you make of all the data and how all of this trade anxiety is manifesting itself on the economy?
Yeah, you're right. I mean, if you look at the GDP numbers, I never really understood the narrative that growth slowed in the second quarter. It actually accelerated. If you look at final demand to private domestic purchasers, that was an old Yellen favorite, but that's sort of core demand out of the U.S. That actually got much stronger in the second quarter. Retail sales,
corporate earnings too got stronger.
Retail sales, as we know, continue to be quite strong through July. That may have been aided by Prime Day, but there's a lot of domestic momentum there. The housing market is recovering from its tax bill-related disruption in 2018, much like the same thing happened in 1987. So that's all fine. But the fallout that you allude to is potentially going to be evident in ISM on Tuesday, perhaps in payrolls a week from Friday. Remember, August payrolls has a notorious history. You get the least number of companies actually reporting to the survey the whole year, and it misses by 80,000 on average and has for some 20-odd years. So I'm not sure that we've really gotten a good view of what that negative confidence shock fallout to the economy is. And one final point I'll make about the markets today, we're sort of patting ourselves on the back on how well the equity market behaved. The recovery in emerging market currencies, the high yielders, Mexican peso, Brazilian real, Chinese RMB, all was pretty punk, right? They're still down sharply for the week. And the Treasury market, the back end is down 12 basis points in yield. It bounced 2 today. So you're not really getting confirmation from EM currencies.
But both of those things tell you that global growth is a problem, and global growth is slowing. Not that the U.S. consumer looks better.
And that's why I think focusing on this business confidence dynamic and whether it's impaired, capital spending and labor investment is so crucial to the story. And we're going to just get a lot more information in the next week or so.
Justin, you're a large cap growth fund manager. Does that mean you're basically a tech fund manager?
No, we go where the growth is, but today that does happen to be a lot in the technology area. We see the best opportunities in tech, consumer, and some of the medical device companies in the healthcare space. But the other gentleman is quite right that the U.S. consumer is very strong today, and one of the best themes is e-commerce within the U.S. consumer. Actually, growth is accelerating. And the opportunity is still immense since e-commerce is only 14% penetrated in the U.S. And a lot of the tech companies are big winners from that. Visa, MasterCard, even Facebook, Google on the advertising side are big winners from the acceleration in e-commerce spending. So we do have a lot of our portfolio in tech.